Hi everyone, Brian Shannon here from AlphaTrends.net. Today is Monday, the 16th of August, 2010. Let's take a look at this S&P 500. We're hearing a lot of scary things lately, such as the Hindenburg omen this past weekend. A lot of press about that. We had the death cross, which, as we know, led to about a 3-week, 10% or more rally, which wasn't really much of a death at all. But you look at the weekly time frame, there are reasons to be concerned here. This market failed to make a high. After looking like this, we had the potential to break this downtrend on the weekly time frame, the lower highs and lower lows here. By breaking 113.20, it would have created a higher low. Now, it doesn't mean we can't recover from here, but when you look at that daily time frame, we're seeing a lot of damage done right now. And realistically, we're probably still should be considered within this range of 105 to 113. You might well ask, well, what about for, these few days? Well, 105 is likely to be an area of support, 104.5, 105, and that was kind of just the failed breakdown that led to that fast move. But anyways, there is reason for concern on this weekly time frame that we have right now. We have this market came up and approached those moving averages, and the 40-week or 200-day moving average is now declining below that, and we do have the potential for a bigger breakdown. As we know, the market had recovered or declined 38.2% of that recovery from the 2009 lows to the highs this year, and that's where it had found that support. Now, one potential bullish scenario here that we can't ignore is that maybe we're going to create an inverted head and shoulders pattern right now. Well, that's a little too far in the future for me to think out, because we still have this range that the market's in, and we're back below this level right here. What we need to do is we need to take it just in little bites to really time it. That is, there's a lot of again, these bearish sounding things that really give technical analysis, I think, a bad name, but you can't ignore the past. Obviously, you look at here's something that I had retweeted this morning. Somebody had posted from the Wall Street Journal, which shows 1937. That's the dark red line, and the pink line is basically, I'm sorry, the dark line is our market right now from the March lows, or basically, what is this, July of 09, June, July of 09 through current, and then the 1937 market, the Dow Jones Industrials, that is, and you can see how closely they're tracking. I wouldn't look at it as a blueprint, but it's something to be aware of and a potential for this market. But anyways, back to the current look. Right now we have resistance at 109. That's where the 50-day moving average is found, and that's basically the midpoint of this range. So maybe we're just going to cross back and forth above and below that, but it does become more reason for concern that we stay trapped below there, and we have the potential that we could head down towards the low end of the range, such as the financials have done. That 1380 really is the main level of that range. We broke below it briefly, and then we have the semiconductors, which are trying to stabilize down near the low end of their range, which has been 25.5 to 29. So a lot of reasons to still be concerned about this market. We have options expiration this week. That's generally a positive event for this market, but as I like to say, when we look at this 30-minute time frame, we have this 5-day moving average. That's the orange line, or when we're looking at 30-minute candles, it's a 65 period equals the 5-day moving average, but we remain below a declining 5-day moving average. So as much as there is opportunity even on these 1-minute charts, when we get above we gap down, for instance, today, and we recovered very nicely above that volume weighted average price, bounce from it as well. There are some good day trade opportunities to the long side, but we still have this pattern where 109 is the resistance, and a declining 5-day moving average says it's guilty till proven innocent. We have to keep an open mind that maybe this market can get back above 109 and then begin to recover. But right now, the odds suggest further, at least market trying to stabilize here. I think it's going to take a push below 107.50 to really bring about the next little panicky wave that might be initially met with some support at 106, but we have to take it in bite-sized pieces, and right now rallies should be considered guilty till proven innocent below this declining 5-day moving average.